Active equity portfolio construction transforms investment ideas into a structured portfolio designed to achieve a manager's objectives while controlling risk. The process begins with the manager's investment philosophy, which determines how opportunities are identified, evaluated, and implemented. Portfolio construction is not simply a collection of attractive securities. Rather, it requires balancing expected return, diversification, liquidity, transaction costs, and risk constraints. Managers must decide how much capital to allocate to each position, how concentrated the portfolio should be, and how exposures align with the benchmark. Successful portfolio construction integrates alpha forecasts with risk management principles to maximize the probability that investment skill is translated into superior long-term performance while remaining consistent with the investment mandate. The building blocks of active equity portfolio construction include alpha forecasts, risk forecasts, portfolio constraints, and optimization techniques. Alpha represents the manager's estimate of a security's expected excess return relative to the benchmark. Risk forecasts evaluate how individual securities and portfolio exposures may contribute to overall volatility and benchmark relative risk. Constraints such as diversification requirements, sector limits, position size restrictions, turnover targets, and liquidity considerations ensure that the portfolio remains consistent with client objectives and regulatory requirements. Managers combine these elements to determine portfolio weights that maximize expected risk-adjusted returns. Effective construction seeks to allocate capital efficiently to the highest conviction opportunities while maintaining appropriate diversification and controlling unintended exposures. Portfolio managers must also determine the degree of concentration within the portfolio. Highly concentrated portfolios allocate significant weight to a relatively small number of securities, reflecting strong conviction in selected opportunities. Such portfolios may generate substantial excess returns if forecasts prove correct but also carry greater idiosyncratic risk. More diversified portfolios spread investments across a larger number of positions, reducing company-specific risk but potentially diluting alpha. The optimal level of concentration depends on the manager's skill, investment process, and mandate. Portfolio construction therefore requires balancing the benefits of conviction-driven investing against the advantages of diversification, recognizing that excessive concentration or diversification can reduce overall portfolio efficiency and performance consistency. Active share is a widely used measure that quantifies the extent to which a portfolio differs from its benchmark. It is calculated by comparing portfolio weights with benchmark weights across all holdings and measuring the percentage of assets invested differently. A portfolio with an active share of 0 perfectly replicates the benchmark, while a portfolio with an active share of 100% has no overlap with benchmark holdings. Active share provides insight into the degree of active management being undertaken and helps investors distinguish truly active managers from closet indexers. Higher active share generally indicates greater deviation from benchmark composition and a larger opportunity for outperformance or underperformance. Although active share measures differences in portfolio holdings, it does not directly measure risk. Active risk, often referred to as tracking error, evaluates the volatility of a portfolio's excess returns relative to its benchmark. A portfolio can have high active share yet relatively low active risk if its holdings have risk characteristics similar to the benchmark. Conversely, a portfolio may have modest active share but high active risk if it makes concentrated bets in specific sectors, factors, or styles. Therefore, active share and active risk capture different dimensions of active management. Together, they provide a more complete picture of a manager's strategy, helping investors understand both portfolio differentiation and the level of benchmark relative risk. The relationship between active share and active risk allows managers to classify investment strategies according to their sources of alpha. Stock-picking strategies typically exhibit high active share and moderate active risk because managers select securities that differ from the benchmark while maintaining broad diversification. Factor timing or macro-oriented strategies may generate high active risk despite relatively low active share because performance is driven by concentrated exposures to sectors, styles, or systematic factors. Investors evaluating managers should therefore consider both measures simultaneously. Understanding whether excess return is expected to arise from security selection, factor exposures, or asset allocation decisions is essential for aligning manager selection with portfolio objectives and risk tolerance. Risk budgeting is a critical component of portfolio construction because it determines how much risk is allocated to various investment opportunities. Rather than focusing solely on expected returns, Risk budgeting recognizes that risk is a scarce resource that should be deployed where managers possess the greatest informational advantage. The process involves identifying sources of active risk, estimating their contribution to portfolio volatility, and allocating risk according to expected reward. Managers may allocate risk across securities, sectors, industries, countries, styles, or factors. A disciplined risk budget helps ensure that active positions are intentional, diversified, and aligned with the manager's highest conviction views while preventing excessive exposure to any single source of uncertainty. Effective risk budgeting improves portfolio efficiency by linking expected alpha with risk allocation decisions. Managers seek to maximize the expected return generated per unit of active risk, often referred to as the information ratio. Positions with stronger expected alpha and higher confidence levels typically receive larger portions of the risk budget, while lower conviction ideas receive smaller allocations. Continuous monitoring is necessary because market conditions, correlations, and risk exposures evolve over time. By integrating alpha forecasts, active share analysis, active risk measurement, and disciplined risk budgeting, active equity managers can construct portfolios that effectively express investment insights while maintaining appropriate control over benchmark relative risk and long-term performance outcomes.